Welcome back. Today we are going to solve a problem from machine replacement and leasing decisions. These are all the asked questions in previous year asked questions in attempt December 2025 last attempt. So easy problems only, but bit comprehensive it look like. But we can solve if we practice well. It means we can solve within 20 minutes. Okay. Uh, okay, we'll solve the problem. Lease decisions is simple only, but when it comes to machine replacement, it will take some time because of the structure. Okay, so what we are saying, Pegas Limited manufacturing something. Okay, due to high wastages, the general manager is considering the replacement of machine X. Okay, replacement of machine X with the machine Y. Okay, then machine X book value rupees 4,80,000. Remaining life 6 years. Then sale price now 1,80,000. Okay, then no zero salvage at the end of 6th year. No salvage. Okay, machine Y details have been given. Purchase price 24 lakhs. Life 6 years. Installation and testing 2 lakhs. Subsidy 15% on PP. At the first year end, the time value of money has to come here. Okay, we are calculating the initial cash outflows. Then comes salvage at the 6th year, which is rupees 3.2 lakhs. Then comes annual savings due to installation of machine Y. Annual savings due to machine Y installation. Salary for 3 workers, which is 1,68,000 into 3. Then 4,80,000 saved from wastage of materials, and then 3,50,000 saved from loss in sales due to delay of delivery. Okay, then comes annual expenses, additional cost, which is, what's the additional cost? Technician 3,90,000. Operation and maintenance rupees 1,54,000. That's it. Then tax rate they have given 30%, or required rate 14%. No tax on savings on loss due to sale of existing machine. Okay, right. Okay, what they are saying here is the sale value of existing machine. No, book value is 4,80,000 and 1,80,000 is the sale value. 3 lakhs is the loss and gain. No, so we'll be getting the tax saving on that. The question is saying that ignore that. Okay, then they have given the PV factors, and then we have to calculate the net NPV and profitability index of the proposal, and Pegas whether should they replace the existing machine or not with a CNC machine, that we have to find out with the NPV. Right. Okay, how the structure is going to be? It's a 4-step approach. we have to follow, right, when we see this kind of questions. Okay, it takes to the answer. Calculate present value of net initial cash outflows. Okay, then comes calculation of incremental depreciation. Then comes calculation of cash flow after tax. This is typically cash inflow after tax. Okay, cash flow inflow after tax because of new machine installation. Then the last one is calculation of NPV and the PI. Okay, now the first step, calculation of PV of net initial cash outflows. Particulars rupees. What's the present value of initial cash outflows you have to find? So what are the initial cash flows we have? 24 lakhs. This is the purchase price, 24 lakhs. Then installation and testing, which is 2 lakhs. Then comes subsidy. Okay, subsidy at 15% on first year end. So what's the PP? PP is 24 lakhs, no? So 24 lakhs into 15% into PV factor first year. PV factor for first year, which is 0.877, because we are calculating the PV factor, PV of net initial cash outflows, no? So 24 lakhs into 0.15 into 0.877, which is 3,15,720. Okay, this is the subsidy we are getting. And then sale value of old machinery, how much we are getting on that? 1,80,000. Then comes salvage value. We don't need the salvage value here. And that's it. Okay, we'll total this 24 lakhs plus 2 lakhs minus 315,720 minus 1,80,000, which is 21 lakh 4,280. Okay, yes, we have calculated now. Then we'll calculate the incremental depreciation. What's the old depreciation? Old depreciation value is 4,80,000 divisible by 6, which is 80,000. Remaining a useful life. Okay, book value divisible by remaining useful life is 6 years. So old depreciation is 6. New asset depreciation. First, for that we have to know the machine asset value, no? Which is PP 24 lakhs. 2 lakhs is the testing and initial installation cost. Then subsidy we have to deduct. Subsidy is how much? 15% here we have found out, but we have present value it, no, so we should not take that. So 24 lakhs into 15% only that we have to take, which is 3.6 lakh. And then salvage value has given for the year of 6th year minus 3.2 lakhs. Any other thing has given? That's it. So calculate the asset value, which is 24 lakh plus 2 lakh minus 3,60,000 minus 3,20,000, which is 19 lakh 20,000 divisible by 6, 3,20,000. So the incremental depreciation, why we are calculating is we are getting the tax benefit by the way of increased depreciation. So how much increased depreciation we are having because of the new machinery, which is 2,40,000. We are going to get the tax benefit for this. Now we have calculated both the things. Then step 3, we have to calculate the calculation of cash inflow after tax. Typically cash inflow after tax, but generally say cash flow after tax. Okay, cash flow after tax have first initially how much profit we are getting by way of buying this machinery. Okay, so what's the annual savings we have? Annual savings is, see, these are the annual savings: 1,68,000 into 3 plus 4,80,000 plus 3,50,000, which is 13,34,000 minus additional cost. What's the additional cost we are incurring? Which is 3,90,000 plus 1,54,000, which is 5,44,000. What's the net incremental cash inflow before tax and depreciation? Okay, so more like a EBITDA. Okay, so 13,34,000 minus 4,000, which is 7,90,000. Then we have to deduct the depreciation, which is incremental. We found 2,40,000, and then we'll get the net incremental cash flow before tax, which is 5,50,000. Then comes tax part, tax at 30%, so which is 3,85,000 is the net incremental cash inflow after tax. Add back the actual depreciation, because this is not a this is a non-cash item, because we are calculating the cash flow item. Cash item is here. So the depreciation is this amount, 3,20,000. Sorry, incremental we are calculating, no? So 2,40,000. Add back the 2,40,000, we'll be getting 6,25,000 as the CFAT. Now we got all the things. Now we can populate into the NPV table. Okay, present value of cash inflows, which is net cash outflow, PV factor, PV of net cash flow. Okay, so what's the net cash flow? 6,25,000. What's the PV factor? Total all this up 1 divisible by 1.14. No, 1, 2, 3, 4, 5, 6, which is 3.8888 into 625, which is 24,30,420. We'll take only 3 decimals, then it comes to 24,30,000. Okay, then present value of cash inflow of which is present value of salvage value. This is also a kind of inflow only, because terminal value, no? So we'll be receiving it. So what's the terminal value for the 6th year? Which is 3.2 lakhs, 3,20,000. Then 6th year PV factor is 0.456. Which is 1,45,920. Then comes present value of cash outflow. What's the present value of cash outflow? That is this 21,000, 21,04,280. What's the NPV? Positive NPV only. So 24 lakh 30,000 plus 145,920 minus 21 lakh 4,280, which is rupees 4 lakh 71,640. Yeah, we got the positive NP. We have to find out the profitability index, which is present value of cash inflows. How much? 24 lakh 30,000 plus 145,920, which is 25,75,920 divisible by 21,04,280 divisible by 21,04,280, which is 1.22 is the PA index, more than 1. So accept, we have to purchase the machinery, we have to purchase the CNC machinery, and we have calculated both the things. That's it. We will go in a structure. It will, the sum will be complete within a 15 minutes, but if you dearrange the order and do na, it will take some time. Okay, that's it. Thank you. Then okay, so sorry, we have another problem also, no, so we'll solve that. December 25, another question have been asked in leasing. The concept is just 2 steps. It will be loan structure, which is loan table, lease structure. That's it. The structure only we have to remember. The sum will come into place. The problem will be, the answer will be come into place. Okay. What's given in the question? Let's quickly populate the figures what they have given in the question. Extract the figures. Gamma, some laptop server system they are producing. Okay, cost is system, they are planning to acquire. The system cost is 80,000. Life is 5 years. Company plans to acquire by the way of borrowing at 12% interest or lease. Okay, the company wishes to know the lease rentals to be paid annually. What's the lease rentals? Because the seller is giving 2 options, whether you can borrow or, but we have to know the lease rentals payable, no. Then the following additional information have been given. Principal will be paid in 5 annual equal installments. Principal is the amount, 5 equal annual installment means 20,000. Okay, then interest, lease rentals, principal repayment are paid at the end of year end, last day of each year. Okay, and then full cost of the machinery will be written over. Full cost of the machinery is full cost of the computer will be written off, depreciated. No, 0. Salvage value is 0. Okay, and same will be allowed for tax purpose. Depreciation is SLM method. So 80,000 divisible by 5, which is 16,000 per year is the depreciation. Okay, then comes the computer will be sold for 4,000 at the year end. And then commission on such sales is 10% minus 10%, 3,600. And then we have to this is the LTCG, since there is no capital gain, STCG. Okay, since there is no book value, the entire amount will be the capital gain. Tax on this is 0.35, 600 and 3.5, just 2. Okay, tax paid, net cash inflow is 2,340. We have arranged every figures here, so just we have to populate into the structure. Okay, now loan structure. Our loan structure will be here: opening loan, principal, closing loan, interest, depreciation, tax save on interest and depreciation. Then comes net cash outflow, which is nothing but principal plus interest minus tax savings. Then PV factor, present value of net cash outflow. Okay, this is the structure. If we go in the structure now, the problem's answer will be come into place. Okay, year 1, 2, 3, 4, 5 5 years or 6 years for the machine life is 5 years is the machine life. Okay, 5 opening loan is 80,000. Principal we are paying every year, 5 installments we are paying now. So 80,000 divisible by 5, which is 16,000. Okay, so principal is standard. We are standardly paying 16,000 every year. Okay, so 80,000 minus 16,000, which is 64,000, minus 16,000, which is 48,000, minus 16,000, which is 32,000, minus 16,000, which is 16,000, 16,000 minus 16,000 comes 0. So interest at how much rate? 12%. 12% interest on this opening loan we have to take. 80,000, 80,000, which is 9,600. Then 64,000, which is 7,680. 48,000, which is 5,760. 32,000, which is 3,840. 16,000, which is 1,920. What's the depreciation? Depreciation is standard. We have calculated that, which is 16,000 depreciation every year. Total these both the things and find 35% tax shield. Okay, 9,600 plus 16,000 into 0.35, which is 8,960. 7,680 plus 16,000, which is into 0.35, 8,288. 5,760 plus 16,000 into 0.35, which is 7,616. 3,840 plus 16,000 into 0.35, which is 6,944. 1,920 plus 16,000 into 0.35, which is 6,272. Yes, done. Then what else we have to do? Principal plus interest is the actual cash outflow, and the cash inflow is the tax savings. So total that will be getting the not totally, we have to deduct the tax saving portion, and then we have to calculate the net cash outflow, which is 16,000 plus 9,600 minus 8,960. I'll just okay, 16,000 plus 9,600 minus 8,960, which is 16,640. Then 16,000 plus 7,680 minus 8,288, which is 15,392. Then 16,000 plus 5,760 minus 7,616, which is 1,411,144. 16,000 plus 3,840 minus 6,944, which is 1,2,896. 16,000 plus 1,920 minus 6,272, which is 11,648. What's the PV factor is they have given in the question itself. So 0.909, 0.826, 0.751, 0.683, 0.621. Okay, what's the present value of those things? 1640 into 0.909, which is 15125.76. Okay, 15392 into 0.826, which is 12713.79. 14144 into 0.751, which is 12896 into 0.683, which is 8807.97. Then comes 11648 into 0.621, which is 7233.41. Then comes the last year. We'll be getting, if they we are purchasing the machine now, we'll be getting the terminal value, no, for 5th year. Terminal cash flow. How much we are getting out of this terminal cash flow? We have already calculated this. The year of at the year of 5th, we are selling at 4,000 minus 10% commission goes. We'll be getting the net of 3,600. So the 3,600 is the cash out, the gross cash outflow, and after that we have to deduct the tax portion also. So we'll be getting the net cash outflow of which is 2,340. Okay, so the thing is, we are getting the income of this amount, but we have to pay the tax also, no? So we have to pay the tax, and we have paid the tax, and the net cash flow, net cash inflow we are getting is 2,340 and 0.621 2340 into 0.621, which is 1453. That will be getting the present value of loan cash outflow 15125.76 plus 12713.79 plus 10622.14 plus 8607.97 plus 7233.41 minus 1453, which is 53,050. Yes, we have got the present value of loan now. So the same thing we have to do it for the lease structure. We'll build here lease rentals, then tax savings. Lease rentals is the cash outflow, tax savings is the cash inflow, net cash outflow is cash outflow minus cash inflow, net cash flow. PV factor, PV of net cash flow. Right? Lease rentals we know, we don't know. Then comes tax savings. Tax savings is how much? 0.35. So 0.35x 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 0.35x. What's the net cash outflow? Net cash outflow is 1x minus 0.35x, which is 0.65x 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 0.65x. What's the PV factor? PV factor, we can take also the PVAF factor, which is total is everything up 1 divided by 1.14 1 divided by 1.1 2 3 4 5, which is total is up everything. You will be getting the PV factor of 3.79. okay, so 0.65 into 3.79, which is 2.4635x. 2.4635x is the PV of lease cash outflow. Now, but we don't know the cash outflow, no. So we are considering the PV loan outflow. Okay. So 2.4635x is equal to PV of loan outflow. So x is equal to 53050 divisible by 2.4635. 3050 divisible by 2.4635. 21,534 is the lease rentals. That's it. The problem is over. Thank you.